All right, good afternoon. You're watching Business World Live here on One News. I'm Jess De Los Santos. Let's take a look at how the local bourse closed today, Wednesday. Shares today had a taste of the 7,000 level, but that's all there is to it as shares plunged back close to where it started this hump day Wednesday. I have here a one-day chart of the PSEI. You'd see here the two peaks here, at least in today's trade, would show you that we did reach beyond 7,000. But then again, like what I mentioned earlier, shares ended the day little change on the downside, in fact, to 6,973.35. Earlier in our broadcast, Christina Ulang of First Metro said the index mirrors what's happening on the macro front with traders moving into the reopening place. That of course, as a healthcare utilization rate improves and infection rate plateaus, she's saying banks stand to benefit the most from the further reopening of the economy, with borrowers having more capacity to pay loans, translating to better non-performing loans ratio. True enough, if you try to take a look at the day's best and worst performers, you'd see here a number of our lenders are in the green. In fact, BDO is a day's best performer. The lender is now at 117.90, up 4 and 6 tenths of a percent. BPI also surging by more than 2%, price now at 88 apiece. Metro Bank and Security Bank completing our list of financial players in the green today. Now, on the downside of ever, you have Jollibee leading the pack in the red by 3.8% to 206 pesos and 80 centavos a share. Now, Emperador, after its buyback transaction, also shed points to 10 pesos a piece, declining by 3.3%. Now, one exciting news here that we have, of course, to discuss, M-REIT Megaworld is planning what could be the country in Southeast Asia's biggest REIT share sale at 27.3 billion pesos. So that's for as many as 1.24 billion shares at a max price of 22 pesos each. Now, shares will include over-allotment option representing a 49% stake in M-REIT. Asset size of properties as it is, it's at 55.6 billion pesos. Megaworld did say that the proceeds will go to 16 projects. However, if you try to take a look at Megaworld's performance today, the stock is flat at 3 pesos and 28 centavos a share. But let's jump out of the main index for a bit to focus on our flag carrier, Philippine Airlines. Its former president and CEO, Avelino Zapanta, is optimistic that the flag carrier will be able to return to its pre-pandemic size of operations in 2 to 3 years' time. That's if they're filing for Chapter 11 proceeds. Now, Tina Ulang said as well that for the economy to really recover, the aviation sector has to be helped. She said helping airlines is helping the economy, and that banks should give airlines some room to allow them to do that much needed turnaround. PAL today unable to turn things around. However, it's down by 0.8% to 6 pesos and 5 centavos a share. Now, lastly, let's have a quick glance at our local currency that dropped today as much as 0.2% as remittances climbed less than what economists pegged. That jumped 12.7% year on year, way below the 19.3% jump that economists were anticipating. The peso, as you can see right now, is down by 0.1% to 48 pesos and 9 centavos to the greenback. Now, here are other headlines we're keeping our eyes on. Unaddressed climate change problems pose a threat to economic gains made by the Philippines. That is according to the Finance Department. DOF Assistant Secretary Paula Alvarez says while the country accounts for less than 1% of global carbon emissions, the Philippines is still highly vulnerable to the effects of climate change, mostly from typhoons. She says the country is expected to incur 117 billion pesos in losses to public and private assets each year due to typhoons and earthquakes. Alvarez says losses could even balloon to over 1.5 trillion pesos in the next 50 years if no mitigation measures are implemented. The DOF estimates a budget needed to implement climate change solutions in the energy, forestry, industry, and transport sectors would take about $4.12 billion or close to 200 billion pesos. Meanwhile, the tourism sector's share to the economy falls in 2020 as COVID-19 forces restrictions on travel-related operations. Now, data from the Philippine Statistics Authority showed tourism share to GDP dropped to 5.4% in 2020 from nearly 13% in 2019. This translates to the industry's lower contribution of 973 billion pesos during the pandemic year. That's a 60% plunge from the 2.5 trillion pesos of tourism industry share in 2019. Philippine officials imposed border control, banning leisure travel and the entry of foreign nationals from high-risk countries. Tourism establishments have yet to resume full operations as part of health safety protocol, with only a few tourism bubbles allowed to open. Now, employment in the sector also fell last year to 4.7 million from 5.7 million in 2019. More and more property buyers are exiting the metro for horizontal projects in other urban areas in Luzon. What's driving the shift, and is a pandemic boosting this change? Let's discuss that with Joey Bondoc, Associate Director for Research over at Colliers. Good afternoon, Joey.
Hi, Jess. Good afternoon.
All right, so investments again, like what you mentioned earlier, now shifting to lots only in house and lot developments. This, of course, primarily from condominiums. What's causing this change?
Well, definitely, Jess, even pre-pandemic, we were already seeing a stable demand for horizontal, for lot-only house and lot projects outside of Metro Manila. But the pandemic has only highlighted the need to be in a bigger lot space, to be in a bigger house. And this is one of the reasons why we're seeing a surge in demand for beachside, beachfront properties, for example, and for lot only projects. A lot of people now are investing in lot only projects because of the potential for capital appreciation, for price appreciation in the next 3 5 years, especially given the improving infrastructure connectivity. So definitely moving forward, we're likely to see a greater demand for these horizontal projects, house and lot only developments.
But Joey, what does that say about the property play in NCR? Is it already in a way saturated, or it's really more of the opportunities beyond the metro?
I don't think it is saturated, but definitely there was a slowdown, especially in 2020. The take up was definitely down. Pre-pandemic, we were recording 45, 50,000 units being sold in the pre-selling market, but this was down to less than 20,000 units in 2020, mainly because of the um, disruption brought about by the COVID-19 pandemic. And not only that, even the developers launched less units in 2020 because they're seeing a subdued demand for condominiums in Metro Manila. But we still see some opportunities for condominiums in the capital region. We see a lot of joint venture projects between foreign and local developers. And then developers have also been targeting millennials, young urban professionals who were not able to travel but now have the cash to make their down payment. So, these developers are trying to lure these potential buyers to acquire their condos by also implementing very attractive extended payment terms. So, these are the trends that we're seeing right now in Metro Manila. And in fact, a lot of developers are starting to launch more units. You have a lot of developers such as DMCI, SMDC, Rockwell that have really been aggressive in launching new projects during the pandemic. So we believe that the launch of new projects will probably recover latter half of the year. And in fact, one of our key recommendations is that these developers should start with their strategic land banking, not just in Metro Manila, of course, but even in areas outside of the capital region.
Okay, but much of the property play as well, of course, Joey, is going to be dependent on remittances. Well, that rose,
That's right.
but not as much as expected by economists. How should that affect take up, especially for horizontal projects, like you were saying? And how should that at the same time affect the strategy here for developers?
if you randomly look at selected house and lot only projects in, say, Calabarzon, Cavite, Laguna, Batangas, Pampanga, Bulacan, Tarlac, you know, these projects have very good take up or sales figures. And they are about 60-90% sold already, despite being launched in the market 2 3 years ago. And if you look at the demand drivers, unsurprisingly, it is the OFWs that would take up about 60, 70, 80% of these projects. And, you know, it's interesting and encouraging as well that remittances reached $33 billion in 2020, about the same level that we recorded in 2019. So Filipinos continue to send in money. And of course, the Business World headline saying that the remittances grew their fastest since what 2016, since November of 2016, looking at April 2020 growth of remittances. So that is very encouraging still. And you know, this OFW market is your main market for your end user projects, meaning if they buy that condo or that house and lot project, they're the ones that will live in those residential projects. So this is the market, the end user market that is less speculative. So we're likely to see a stable demand from this market moving forward.
Now let's shift a bit this time to office spaces. Interesting. What's interesting about your report is that we're seeing a lot of interest in areas still outside Metro Manila. So give us an idea which locations are the most attractive at the moment, and why is interest picking up in these locations?
Okay, let me start with the results of our survey. When we did our survey, a short survey during our first quarter property market presentation, the top locations were unsurprisingly Cebu, Pampanga, and Laguna. But if you look at actual transactions that were closed the latter part of 2020 and first quarter of 2021, it was Iloilo that really captured a lot of transactions. And why? Of course, Iloilo is your main education academic hub in Western Visayas. Attracts a lot of students. It has a skilled manpower, and interestingly, Iloilo is not just for back office or support outsourcing operations. In fact, Iloilo has become very discerning already, and they have been really welcoming knowledge process outsourcing companies, KPOs, or those that handle higher value outsourcing operations. So definitely, Iloilo is a location that we need to watch out for. There's very low vacancy in Iloilo right now. Of course, you have the likes of Mega World with their Iloilo Business Park, and take up is really strong in Iloilo Business Park, developed by Mega World, and it also helps that it is an integrated community. That's why you see a lot of developers already, SM and even Mega World already developing their integrated communities, because you know it's the first mover advantage, and also take advantage of the fact that it is a city that attracts a lot of BPO companies, multinational corporations. So definitely a location to watch out for outside of Metro Manila is Iloilo.
All right, now, Joey, this time around, let's discuss retail. That, of course, has seen quite a disruption
Yep.
during the pandemic here in 2020. How is that going to affect demand for retail spaces moving forward? Should we be expecting more closures?
Definitely, we're projecting a higher vacancy for Metro Manila in 2021. So from 12.5% in 2019, this increased to 14% in 2020. Vacancy is likely to increase again to 16% by the end of the year, end of 2021. And this only means that there will be more closures, more closures of physical brick and mortar mall spaces across Metro Manila. A lot of tenants are, of course, migrating online. They've been maximizing e-commerce platforms. But what's encouraging also, Jess, is the fact that a lot of retailers are implementing brick-to-click strategy. So they're not just online, they're also offline. So they're maximizing both the presence, because you know, a lot of people still want to go back to malls after this pandemic, once the lockdown restrictions are eased by the government. In fact, we're seeing attraction already. So a lot of retailers are really maximizing the fact that Filipinos love to go to the malls. These malls are de facto public spaces. You know, you get free air conditioning, you get to eat, perhaps eventually watch a movie, buy supplies, groceries, etc. So you get to do a lot of stuff, even renew your driver's license. So a lot of things we can do inside malls, and Filipinos will continue to be attracted to go to malls, and therefore we expect an increase in consumer traffic once these lockdowns are eased by the local and national governments.
So at least that at least is one good option for mall operators and retailers to tap e-commerce without necessarily compromising their brick and mortar stores. Thank you
Definitely.
very much for your insights this
Thank you.
afternoon.
Yes.
Again, Joey Bondoc, Associate Director for Research over at Colliers. And those are the biggest stories this trading day, June 16, 2021. Catch Business World live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jess De Los Santos. We are One News. Mask on, wash hands, and stay safe, Philippines.